Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 288 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Matt is out today, so unfortunately you are stuck with me for a solo episode, so hopefully not too boring for you, and hopefully we'll have Matt back on the podcast next week. As always, we will quickly review the month-to-date and the year-to-date performance of the major market indices that we track, the status from Y charts, and as of the market close on February 12th. S&P 500 index up 0.2% for the month of February and up 2.9% for the year. The Dow Jones Industrial Average down 0.4% for the month and up 4.3% for the year. The NASDAQ Composite Index up 0.1% for the month and up 1.8% for the year. The Russell 2000 Small Cap Index down 1.3% for the month and up 1.2% for the year. And finally, the Vanguard All World ex-United States ETF up 1.9% for the month and up 5.4% for the year. So definitely a stronger start to the year for international stocks than we have seen in quite some time. And I think this is something that Matt and I will get into over the coming weeks, as we are starting to see broad strength across several different country indices that are so far outperforming U.S. stocks. So we'll see if that leads into something larger for the remainder of the year. 3-month Treasury rate sitting at 4.35%, the 2-year Treasury rate at 4.36%, and the 10-year Treasury rate at 4.62%. Big headlines, current events from this past week. Yesterday, the latest inflation report came out, and the Consumer Price Index, or CPI, was released yesterday morning before the market opened. And that report indicated that inflation rose to 3% year over year in January, which was up from 2.9% in December. And this had marked the highest annual increase since June of 2024. And on a monthly basis, the CPI increased 0.5% in January, following a 0.4% rise in December. Key contributors to this uptick included shelter, food, and energy. And I think obviously most notable for everybody that they see at the grocery store every week was food prices, and they went up by 0.4%, with the food at home category increasing 0.5%. Notably, the index for meats, poultry, fish, and eggs surged by 1.9%, driven by a significant 15.2% jump in egg prices, which is the largest increase since June of 2015. Energy index also climbed by 1.1%, with gasoline prices rising by 1.8% and natural gas by 1.8%. So not surprising numbers if you've fueled up your gas tank over the past several weeks or any time so far in 2025. Excluding food and energy, the core CPI advanced by 0.4% in January. Increases were observed in categories such as motor vehicle insurance, which was up 2%, recreation up 1%, used cars and trucks up 2.2%, and medical care services up 0.2%. That wraps up kind of the big headlines and current events for the week. So we will move on to tweets, articles, and research from this week. The first thing that I had was a tweet by David Zarling on February 3rd of 2025. David Zarling and Ian McMillan have a weekly podcast that they do on Fridays. And I will get you the name of that right now, since it's on my recurring list of listens. That's really good. Encourage you to check it out. It's called The Weekly Trend. They do a really nice job of kind of giving a brief summary of what happened in the past week with markets specifically. But he tweeted this out. In general, we'll throw this up on the YouTube video. This will also be in our show notes. It's a chart of the S&P 500 from roughly October of 2016 through roughly August, September of 2018. And it shows all of the different times that we had tariffs or trade wars, or there were big news headlines about Trump putting in new tariffs or starting a new trade war with another company. And as you can see in this chart, this happened several times throughout 2017 and 2018. And what you'll see, which is very interesting, is 2017 was a great year for stocks. And this chart is the S&P 500 specifically. But it just goes to show that, we shouldn't be making investment decisions based on these short-term news headlines. Everyone says that tariffs are going to rattle the U.S. economy and wreck the stock market. But back in 2017, we've seen this song and dance before, and that was not the case. I think another interesting scenario is obviously in Trump's second term, he's already talked about and placed a 10%, I believe, tariff on Chinese goods coming into the country. Well, he did implement tariffs on China back in 2017, and 2017 was the best year for Chinese stocks, for several years. So it's not always what it seems to be, and I think we've talked about this before, but if we had the news cycle for the next 6 months, it doesn't guarantee that you're going to be successful investing in the markets, because a lot of times when you see a news headline, you think that one thing is going to happen in the market and actually the opposite happens. And the best example of this, which I used in a client meeting yesterday, was during Trump's first term. Obviously he is pro oil and gas, traditional energy. Traditional energy stocks did very poorly during Trump's first term, and green energy or clean energy stocks did very well. And everyone's like, well, that doesn't make a whole lot of sense. And if you fast forward to when President Biden was in office, it was kind of the opposite. Traditional energy stocks did way better than your clean or green energy stocks. So that's just one example of with you having some sort of information, you think that there's going to be a certain outcome, and a lot of times it's just the exact opposite. So I think this is a really good chart from David. It should hopefully quell some fears over tariffs. I think it's going to be kind of the same situation as Trump's first term, and he used tariffs as a bargaining chip more than anything else. The last podcast, we mentioned that Trump had already delayed the implementation of tariffs on both Mexico and Canada. So I think it's being used as a bargaining tactic more than anything else. Second thing that I had was a tweet from Evan SS6 on January 30th. Jenna will put this up on the YouTube page. It'll be in our show notes, but it's a chart of Bitcoin. And it shows different instances where Forbes has had covers of their monthly magazine, and it's related to cryptocurrency or Bitcoin in some way, shape, or form. And as you can see, looking at this chart, back in 2018, Forbes had a cover on their magazine. It said Crypto's Secret Billionaire Club. And as you can see, this coincided pretty closely with the short-term top in Bitcoin for 2018. So for the rest of the year, and actually through 2020, Bitcoin did not make a new high for several years after this magazine news cover was released to the public. And then similarly in 2021, Forbes came out with a magazine cover that had Sam Bankman-Fried on the front of the magazine. And this was like right before, he went down for his large scam and scandal within the crypto industry, stealing money from investors. So that also marked a short-term top in Bitcoin in mid to late 2021. And then Bitcoin did not go on to make a new all-time high until 2024. So again, after this came out, it was several years of a pullback. And then if 2 times weren't enough, just earlier in 2025, there was a Forbes article posted recently with the title was The Bitcoin Alchemist. And it has a picture of someone in the crypto industry. I think it's Michael Saylor, who is a big Bitcoin supporter and fanatic. Again, we're sitting at all-time highs when this magazine came out. So just putting caution out there to the wind for people, as we've seen this song and dance before. It by no means says that crypto has to fall or Bitcoin has to fall by 20, 30, 40% and not make a new high for several years. But I just think it's worth pointing out that typically when a certain security, a certain product, a certain market gets this type of notoriety in the mainstream media, typically most of the gains, at least short term, have already been made. So I think this will be a fun one to come back to in a year or two and see if Bitcoin bucks this trend this time, or if we get another several multi-year sell-off in crypto and Bitcoin specifically after this Forbes magazine cover. Third thing that I had was, again, a post on X from Aurelius on, this was January 15th of this year. Jenna will throw this up on the YouTube page. It is a chart of the S&P 500. 100 is the blue line in the chart. And then the blue line is the S&P 500 trailing 12-month operating earnings. So trailing 12-month earnings for publicly traded companies in the S&P 500. The green line is the actual price of the S&P 500 index. And Aurelius said, hang it in the Louvre. And again, it just shows you that over time, the S&P 500 index price has followed the path of earnings over time. So, I think this is why Matt and I bring up publicly traded companies in their earnings reports every year when this happens, because earnings are vitally important to how the S&P 500 performs over the long term. So it's very clear in this chart that the price of the S&P 500 follows those earnings results. And when companies are reporting better earnings, typically we're in an environment where stocks do well. And on the contra to that, when companies are reporting slowing earnings growth or even negative earnings growth, that's when you see stocks struggle for a period of time, because at the end of the day, for investors to get a return on their money, these publicly traded stocks need to be efficient, operating profitably, and returning money to shareholders. So just thought that this was a really good, simple chart to kind of explain the movement in stocks, and specifically in this case, the S&P 500. And this data was from Investment Strategy Group, Bloomberg, and S&P Global. Moving on to the fourth item that I had, and this was a piece of research from Goldman Sachs back on February 8th, and it counts the number of mentions of AI during earnings calls. So this is as of February 4th for companies reporting Q4 earnings for 2024. The mention of AI in S&P 500 firms' quarterly earnings calls was up 50% in Q4 of 2024. So I think it just goes to show you that this trend of AI is not going away anytime soon, and more likely than not, it's just in the early innings. I'm not saying it's going to change the world in the next 2 to 3 years, but this is not going away, and it leads me perfectly into my next point, which is CapEx spending for publicly traded companies. So Amazon just announced that they are planning to invest $104 billion in CapEx, or capital expenditures, in 2025 when they reported earnings recently. Alphabet, the parent company of Google, also guided for a $75 billion in CapEx for 2025, most recently during their earnings call. And in total, that's $179 billion in combined capital expenditures for just two of the seven magnificent seven companies, with the majority of this spend going towards AI and AI infrastructure. And just to break that down a little bit more, for those who might not be familiar with it, capital expenditures, often referred to as CapEx, that's the money that publicly traded companies spend on big long-term investments to either maintain or grow their business. So you can think of it as buying things that help the company make money for years to come. Examples are, buying new equipment or machinery, upgrading technology and software, and expanding their footprint. And this is an important metric for investors to watch because it can signal whether a company is investing for future growth or just spending money to maintain its current operations. So I think this is important to highlight because there's been a lot of talk over the past month or so about this newer Chinese AI company, DeepSeek, that had threatened to wreck and upend the current technology environment and AI industry with this specific piece of DeepSeek AI claiming to be better, more efficient, more accurate than anything that's on the market today, and also created with a hell of a lot less money, technology, and investment. So this posed a huge threat, obviously, to major semiconductor manufacturers across the world. I won't get into that today. There were some truths that came out of the DeepSeek news headlines and some not so true things, I'll put it that way. But I think the important thing to take out of this, or the important thing that I took out of this, is some of the most big, powerful, successful companies in the world are ramping up their spend on AI and semiconductors in 2025. So these CapEx numbers that I just told you were above and beyond what they had initially planned for earlier in 2024. So if, this product that came out of China, DeepSeek, really was all it was cracked up to be, I don't think you would see the smartest companies in the world with the most resources in the world devoting this much capital towards investing in their AI infrastructure. So again, I could be wrong on that, but I think, when you have some of the best companies in the world, ramping up their spend on a certain piece of technology or infrastructure, it's something that we should take note of. So moving on to the financial planning topic of the week, this was a blog post from Mike Piper on February 10th, and Mike was discussing Roth versus deferred contributions to your retirement accounts. This is something that we've talked about several times on the podcast before, but I thought it would be interesting just to bring it back up again if people were curious or we have some first-time listeners, because one of the most popular questions that we get at our firm is, hey, should I be contributing, making Roth contributions to my 401k or my IRA, or should I be making pre-tax or tax-deferred contributions to my 401k or my IRA? And the answer is it really depends on your situation. So one of his readers wrote in and asked whether he should be making Roth or tax-deferred contributions to his retirement accounts. And I just want to briefly read some of Mike's response here as follows. And this will be again in our show notes if you want to come back and take a look at that. So Mike says, in general, the driving force behind the Roth or tax-deferred decision is that if your current marginal tax rate, which is the tax rate on the next dollar of income that you make, is greater than the marginal tax rate that would be paid on the money whenever it comes out of the account later, tax-deferred contributions are generally preferable, i.e. making a deductible contribution now while your tax rate is high. But if your current marginal tax rate is lower now than the marginal tax rate that would be paid on the money whenever it comes out of the account later, Roth contributions are generally preferable. And then there are three other factors, all of which favor Roth contributions. Roth accounts have no RMDs or required minimum distributions during the original owner's lifetime. Contributions to a Roth IRA can be withdrawn tax-free and penalty-free at any time. So Roth IRAs, as well as Roth 401ks or Roth 403b contributions that have been rolled over to a Roth IRA, can do double duty as an emergency fund in some cases. And the third, a maximum contribution to a Roth account in a given year allows you to effectively contribute more than the same contribution to a tax-deferred account. For instance, with a $7,000 Roth IRA contribution, the whole $7,000 is yours. You get to take advantage of $7,000 of tax advantage space. With a $7,000 traditional IRA contribution, a portion of that account is essentially the government's money. You're letting the government use a portion of your tax advantage space because, again, when you take that money out of the traditional IRA in retirement, you have to pay tax on it because it hasn't been taxed yet. So at the end of the day, just to wrap up, if you're in a higher tax bracket now than you will be in retirement, then I think it makes sense to have tax-deferred contributions or pre-tax contributions. So tax that money at a lower rate at some point in the future, and vice versa. If your current tax rate is lower than what you expect it to be in retirement, maybe you tax that money now at the lower rate if you anticipate your tax rate is going to be higher on that money several years down the road. So I know it's not a perfect answer, and people want a definitive, should I be doing Roth? Should I be doing traditional? My blanket kind of statement is I think it's good to do a little bit of both, because when we're talking about providing income to someone in retirement, me from a advisor standpoint, I can offer a lot more help with managing clients' tax liabilities in retirement if they have different buckets of money. So I like most people to have traditional pre-tax IRAs, Roth IRAs, and a taxable investment account that's not a retirement account, so just a pure brokerage account, because from that standpoint, I can help people pay a lot lower taxes in retirement. Whereas if someone comes to us and they have all of their money saved in a traditional pre-tax IRA, I really can't do much to help them lower their tax bill, just because anything that comes out of that account is going to be taxed at their ordinary income tax rate at that point in time. So good post from Mike here. He has a lot of good content, so I'm sure we will be sharing more of that in the future. Just before we wrap up for the week, earnings season is starting to slow down. However, there's still a good chunk of publicly traded companies, specifically in the S&P 500, that still have to report through the end of February. So over the next couple of weeks, we'll still be pretty heavy on the earnings announcement side of things. But once we get to the end of February, that should calm down a little bit. But other than that, I hope everyone has a wonderful week. It seems like everyone and their mother that I know is sick right now. So if you are battling a sickness or have family members, friends battling a sickness, I hope you get through that soon. Mia, just to share a personal story, had neurovirus last week, and now she, just got over that, took her back to daycare. Came home the first day with a cough from daycare, and now has a mid to high grade fever. So just when one sickness ends, the other one is starting for the McEvely family. So hopefully you guys have already gotten past it. But if you're not feeling well right now, we hope you feel better soon. Thank you for listening to episode 288 of the Independent Advisors Podcast. We will be back with you next week for episode number 289.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.